So I wish for everyone watching to have a portfolio in the hundreds of thousands, if not millions. And again, if that's the goal, if that's where one's going, in my opinion, dividend growth stocks, individual stocks, are going to be the foundation of that financial strategy. Hey everyone, I'm back with another video about dividend growth investing. Today's video is an exciting one. It's a response to many of your questions. I've received this question so many times that I had to finally go ahead and answer it. So the question goes like this. Hey Ian, I hear what you're saying. I like this concept of dividend growth investing. I want to invest for passive income and cash flow. I want to receive dividends in my life, an abundance of them that can pay for my living expenses. However, I'm not so certain I want to buy individual stocks like you have, Ian. I want to instead consider buying these exchange-traded funds, or ETFs, which are basically financial instruments that one can go out on the stock market, buy them like stocks, but they actually represent a basket of stocks. They're a mutual fund of sorts. They're typically run by a mutual fund family, and they have a bunch of stocks in them. So you're basically buying one stock, but it represents a basket of stocks. And these ETFs have different themes, and some of them are dividend-themed ETFs. So the question is, hey Ian, can you compare and contrast dividend-paying stocks, individual stocks, versus dividend-paying ETFs, or high-yield ETFs? And so let me give you two examples. These are two examples that a subscriber, one of you, actually included in your comments. So just for everyone's background, I want to include these very two examples. One of them is ticker symbol VYM. This is the Vanguard High Yield ETF. Right now, that ETF has a starting yield of about 2.94% yield. So just about 3%, just under 3%, not a bad starting yield. The other one that was mentioned was VIG, the Vanguard Dividend Appreciation ETF. This one is a starting yield of 2.02%, a little bit lower there. But I imagine the reason for that is it's an ETF focused on those dividend stocks that are in higher growth mode. So probably the theory behind that ETF is you give up a little bit on short-term dividends with the hope of quicker dividend growth. So the question becomes, hey, what should one do? What should one do? Should they go the stock route or the ETF route? And so I want to just speak from my personal experience, how I look at these instruments, how I compare and contrast them, where I go with stocks, where I would consider going with ETFs, but just going to kind of add this up front. If you've been watching my channel for a while, you probably know that I'm not a big fan of ETFs and mutual funds. I am a hands-on investor. I like to buy individual stocks, and I like that because it offers me superior returns and more control. That being said, there are certain instances where even I own mutual funds, and that's typically if it's in a retirement vehicle where that's one's only choice. There's no other choice but to go with mutual funds. So let's jump right into it. Well, I did a video a while ago on how starting yield doesn't matter. Starting yield doesn't matter. It's all about how the yield grows over time. Because when one buys dividend growth stocks in the early days, they're not looking to live off of the dividends. They're looking to get the money working for them so that the money can compound so that 10, 20, 30 years out, one can live off of the dividends. And so starting yield isn't super important. It's not as important as how the yield grows. That being said, I like to optimize my portfolio to have a current yield in the 3% range, oftentimes between, not lower than 3 for sure, oftentimes between 3 and 3.5. That's a good sweet spot for me for my current dividend yield. And so with these, just looking at these two examples, off the bat, VIG, Vanguard Dividend Appreciation, that is too low of a starting yield for me. I own stocks, mind you, that have yields that low. Not many of them, but a few. But I counterbalance them with stocks that have really high current yields, so my average is about a 3.5. So VIG, that's just a little low. And if I were ever to go that route, I would have to counterbalance that with another ETF or stock or instrument that would raise my current yield. So the other one, even the VYM, the high yield ETF, at a 2.94, it's still a little bit below my sweet spot. My sweet spot's really between 3 and 3.5. Definitely not below 3. It's typically more towards the 3.5 range, or at least 3.25. And so I'm sure there's other high yield ETFs out there that provide a higher yield, but just using these two, the starting yield doesn't matter. It's all about the growth. But that being said, for me, I've always had success optimizing my current yield to about a 3.5. And the reason for that is it means I'm buying value. In any market, there are always going to be stocks that are on sale. And so if I buy stocks wisely, I buy the stocks that are on sale, I can get a current yield around 3.5. So talking about stocks that are on sale, this is actually my second point. When one buys an ETF, they're buying a basket of stocks. They're buying the whole basket. Within any basket of stocks at any given time, there will be stocks that are overvalued and stocks that are undervalued. And by buying a basket, one is guaranteeing themselves, in my opinion, a suboptimal return. The reason for this is you buy the basket, you can't just buy the stocks that are on sale. You can't forego the stocks that are overvalued. However, let's say even, here's an interesting hypothetical. Instead of buying the Vanguard ETF, maybe I just buy all the stocks that are in the ETF one by one individually. Well, if I do that, at least I have control. So when the market fluctuates and certain stocks in the basket go down and become undervalued for whatever reason, because the market, in my opinion, is not efficient, it is inefficient. There are sales all the time, there are opportunities all the time. I am living proof of this. I have achieved superior results over the years, time in, time out, time and time again, because the market is not efficient and I am willing to look for opportunity and to strike when opportunity comes my way and to put money into opportunity. And so hypothetically, even if I bought all the stocks in the ETF, at least then when the ones that went on sale are on sale, I can average into them. By the way, I don't sell stocks. I hold stocks forever. I don't like to cut my winners short. If stock's going up and it's a winner, I let it go. I want it to win even more. So I don't sell winners, but that said, I like to double down on, I don't like to call them losers, but opportunities. When a good quality stock, a winner, is on sale, I love to jump on that opportunity. And I just can't do that with an ETF. It's really difficult. And so fundamentally, I love control, and that's and the control itself offers me superior returns in my dividend growth portfolio. It gets me to the goal, financial freedom, quicker. It gets me to massive cash flow quicker. So that's the route that I like to go. What else? I believe a lot of people out there start with mutual funds. This is how I started. When I first started in high school, believe it or not, this might have even been middle school, long time ago. The first financial investment I ever made was a mutual fund. And the reason I went with a mutual fund is I started hearing about this investing thing from my friends. They were in, one of them was in a mutual fund. And so I went with mutual funds. I think a lot of people start like this. These mutual fund companies spend a lot of money advertising. These mutual fund companies are everywhere. For a newer investor, someone that's newer to the game, it seems like mutual funds are the obvious choice. It also seems, based on all the marketing out there, like individual stocks are beyond one's reach. I'm here to say that if one puts in the time, and it does take time, it takes a lot of time, but if one puts in the time, it's totally possible, even for a beginner, to succeed with individual stocks. And one can buy individual stocks for as little as $25 at a time with dividend reinvestment plans, where one can buy stocks directly from the company themselves through transfer agent that the company appoints. There are other low-cost brokers out there, or even no-cost brokers that I've been hearing about as well. Whole separate topic. I like to go with at least a low-cost broker, in the sense that I want no-cost brokers are, in my opinion, more of an unproven business model. They're newer to the game. We'll see how that pans out. I wish them all the success in the world. But with my money, I like to have it either directly with the company through a transfer agent, or in a broker that is world-class, world-renowned, that the name has been there forever and will continue to be there forever, because we're talking about my hard-earned money here. And so my family's money, I want to trust it with the right broker. But anyways, that's another video. I can link to it in the description. That was one I did a while ago in response to another subscriber question. But anyways, buying stock is cheap, it's fun, it's easy. Even a beginner can do it if they put in the time. So in my opinion, one should not be scared. One should not be scared to get into individual stocks. There's so much opportunity with individual stocks, individual growth stocks. And we're not talking about penny stocks here. We're not talking about trading or swing trading or high-tech, high growth stocks. We're talking about world-class, blue chip, household names that have been in business forever. That's the cornerstone of my dividend growth portfolio. And that mitigates, in my opinion, a lot of the risk that others may face buying potentially fly-by-night, potentially high risk, potentially volatile individual stocks. Those are not part of my plan. My plan is a conservative plan, but it works and it's proven. What else? Where would I consider one of these ETFs? Where would I consider it? Totally, I would consider it in a retirement account. In certain retirement accounts, such as 401ks, and I did another video on this, I'll link to it in the description below, there aren't a lot of options. And most of the options are managed mutual funds, and managed mutual funds tend to, historically, have not performed very well. And so, if I had a choice between a managed mutual fund and an ETF or an index fund, especially an ETF that was a dividend ETF, boy, I would go with the dividend ETF. Of course I would, if that was my only option. But if I had the option, a third option of individual stocks, I would go that route. Okay, here's a good one. Let's say my portfolio was $1,000 or less, and I thought that it wasn't going to grow much. Maybe my goal was to get it from 1,000 to 5,000 over the course of maybe 5 or 10 years or more. ETFs could make sense in that case. If one has no intention of having a portfolio that is 10,000, 20,000, 100,000, 500,000, 1 million plus, if no one has any intention of doing that in their lifetime, it's not part of the goal, it may make sense to go with an ETF if one wants a portfolio, intends to have a portfolio that's in the hundreds of dollars or maybe $1,000, because it provides diversification. And also with a portfolio of that size, does the active management warrant one's time? Maybe not. And so in those types of cases, I think an ETF could make sense, and especially a dividend ETF could be a great one, because I believe that dividends are the greatest thing around. I love dividends. And so regardless of what I'm doing, I'm always going to optimize towards the investment that offers the dividend yield. But again, I imagine most people watching here are aspiring towards financial freedom, or maybe not complete financial freedom, but at least a life where maybe 1/4, 1/2, or more of your living expenses are covered by passive income and cash flow. Cash flow that comes while you're sleeping at night. And if that is the case, most likely your portfolio is going to end up being in the several hundreds of thousands of dollars, if not upwards of $1 million. Obviously, this won't happen overnight, but it will happen because of the miracle really of compound interest, but also the miracle of being humble, being persistent, staying in the game, managing one's budget, and being persistent and conscientious of one's personal finances. It may sound out of touch, but the snowball can start growing pretty quickly. And so if you see yourself, and I would like to encourage everyone out there to dream big. Dream big. Dream even bigger than you think is possible. There's no downside. It will only motivate one. It will only get one closer to their goals. So I wish for everyone watching to have a portfolio in the hundreds of thousands, if not millions. And again, if that's the goal, if that's where one's going, in my opinion, dividend growth stocks, individual stocks, are going to be the foundation of that financial strategy, not ETFs. Not having a middleman, not limiting one's ability to double down when a stock is on sale, not paying fees to companies out there, but really buying individual stocks. My name is Ian Lopuk. This is ppcian.com. If you enjoyed the video today, I please invite you to subscribe, to like, to comment. The comments like the ones I've been receiving, fuel videos like today's video. I greatly appreciate them. They mean the world. It's the greatest way you can thank me. Before I leave, just a friendly disclaimer. I'm not a licensed financial advisor. Today's video is not investment advice. It is just for your fun and entertainment. If you are going to go out and invest capital in the stock market or anywhere else, please do consult a licensed financial advisor first. Thank you so much for watching. I will see you in the next PPCE and dividend investing video.